Hello, my name is Sam Cosh. I'm the lead manager of European Assets Trust.
And I'm Lucy Morris, the co-fund manager of European Assets Trust. And European Assets Trust is a fairly unique investment trust in that we run a concentrated portfolio investing in some of Europe's most exciting and dynamic small and mid-cap companies, whilst also providing an attractive level of annual income. So we pay out 6% of the year-end NAV in the form of 4 quarterly dividends, and that's funded from both a combination of capital and underlying income in the portfolio.
Year-to-date performance has been good. We are beating the benchmark by a reasonable distance, and Q2 performance has also been good. In total NAV returns, share price is slightly lagging behind that given the widening of discounts across the sector, but we're happy with the first 6 months. If we look at more recent performance, our consumer stocks have fared well. They've sort of recovered from the post-COVID slump where retailers were struggling with excess inventory. We think this is now behind them. We're seeing demand patterns return to normal. And we're also seeing some strong performance from our technology holdings. For example, our semiconductor stocks have had a very strong second quarter. And this was on the back of the news in the US from Nvidia, a chip producer, who jumped after announcing very strong performance from the first signs that generative AI is going to drive momentum in the sector. And we saw both our holdings, ASMI, a long-standing holding listed in Holland, semiconductor equipment manufacturer, but also a newer holding, BE Semiconductor, which we added earlier in the year, performed very strongly on the back of Nvidia results. In the consumer sector, I think it's worth talking about our Irish listed house builder Cairn, who are one of the few house builders of size in the market and are able to deliver substantial volumes into a market where there's a severe housing shortage. And we're seeing Cairn really benefit from that with a very strong order book and improving profits, margins and cash flow, a lot of which is getting paid back to us. So overall, we're happy with the first 6 months and the second quarter.
So one of the best performers this year is our long-term holding, Gerresheimer. They're a pharmaceutical packaging company supplying the large cap pharma companies with drug delivery systems. We like this business for a number of reasons. Firstly, it's got very good long-term structural growth prospects as due to demographics. We've got an increasing global population, we've got an aging global population, we've got increasing wealth in emerging markets, and we've got the shift towards more personalised medicine. On top of that, we like to buy businesses that have strong barriers to entry that prevent competition coming in and eroding the margins and returns that company can make. And Gerresheimer's barriers to entry are very strong. If a pharmaceutical company wants to change, for example, its asthma inhaler or its auto-injector, it has to go back to the regulatory body to get the whole drug reapproved as they form part of the drug delivery mechanism. This is time consuming, comes with risk, and typically their customers don't tend to do it. So they're very sticky in terms of sticking with Gerresheimer for the long term. The main reason it's delivered such good performance so far this year is that it's exposed to the new GLP-1 drugs being developed by the likes of Eli Lilly and Novo Nordisk to treat obesity and diabetes. And we should continue to see a long run rate of growth as these drugs increase their capacity and are increasingly rolled out to customers and to patients. They've just delivered very strong first half year results during a great organic growth increase as well as a margin uplift.
So as a reminder, we don't make portfolio changes in European Assets Trust based on any macroeconomic view. We're stock pickers. It's about finding companies for us. So, in this year, we've been quite productive. We've sort of benefited also from being part of Columbia Threadneedle and the wider research team. And maybe I should highlight one of our recent additions. So we added a Swedish listed company called Surgical Science. These are the leaders in providing simulations, software and hardware, helping surgeons train for minimally invasive surgery. And the real growth for this business is coming from the fast growth in robotic assisted surgery, which itself is while growing quickly, a very small part of total surgery. In fact, the penetration rate globally is under 5%. And with better outcomes and improving recovery times, robotic surgery is growing very quickly, and Surgical Science are the leading providers of simulation software for that industry. We also seen the business develop much better economics. It was brought together under a M&A consolidation, but what we're seeing now is margins improve, cash flow improve, and an already strong balance sheet getting stronger as they are selling more software, which is higher gross margin and has a higher recurring revenue to it. So it's a really interesting business, leader in a real niche area, but growing quickly and showing great economics.
From a macroeconomic perspective, we obviously can't shy away from the fact that the data has deteriorated over the last couple of months. The PMIs in Europe have been particularly weak, especially on the manufacturing side, as we're really beginning to see the effects of higher interest rates start to feed through into the market. However, we would like to point out that European valuations are particularly attractive when you look at them on an equity basis versus the rest of the world. And if you delve into that even further, European small caps are trading at a discount versus their long run average when compared to their European large cap peers. So smaller companies have underperformed so far this year, but when you go back and you look through over the longer term, they have delivered much better performance than their large cap counterparts, and we continue to believe that will be the case regardless of what macroeconomic situation we enter into. We think very much in the short term, market direction will be led by the central bank's decisions on interest rates, but over the long run and for the long run, we'll just continue to follow our investment philosophy and process of looking for high quality businesses that are well run and attractively valued to add them in as holdings for the investment trust. For any more information, please visit our website or click the link in the description.